Okay, so nice to meet you, everyone. So basically, we should now be able to prepare a very generic consolidated financial statements, right? Just like what you have done in your midterm test, right? That is generic consolidated financial statements. Now we continue to complicate everything. Last week, we complicated by having parent, subsidiary, lower tier subsidiary, right? So parent, subsidiary, lower tier subsidiary. Always in the previous example, we assume that there's no change in shareholding, no change in share capital, no change in group structure. Today, we talk about what happens if there is a change. After we have acquired subsidiary, we may purchase more shares, or we may dispose some of the shares, or the subsidiary actually may issue some more shares. Right? So what happens if all this change happen? So today, we talk about this. Say, for example, we may have increased our shareholdings. Actually, we got this case one before. Right? We said that we may purchase some shares before, and then finally, we achieve control. At the day when we obtain control, this is the day of acquisition. So therefore, from the day we have got 33%, this is not yet control, until we got 50, more than 50. This is the day of control. Usually we call this step acquisition because we acquire a subsidiary in steps. We may call it steps acquisition. We may call it business combinations achieved in stages, or we may simply call it we acquire companies in successive stages, right? So anyway, this is the step acquisition. Another possibility is originally you have got 51%. If you have got 51%, this is already a subsidiary. As we have said before, consolidation starts at the day of acquisition. That means the day when we obtain control. Therefore, when we obtain 51%, this is already the day of acquisition. And therefore, this is the day when we have to calculate the goodwill. So goodwill will be calculated at the day of acquisition. Any further purchase after the day of acquisition will not affect the calculation of goodwill, right? So we'll talk about these cases today. So this is the increase in shares. So before the break, we talk about the increase in shareholdings. After the break, we talk about the reduction in shareholdings. Why we sell some of our shares. For step acquisition, or sometimes we call it business combinations achieved in stages. Actually, when we discuss about how we calculate goodwill, we have talked about this case. Right? You may have first 33%, and then you purchase 18% more, and therefore you got more than 50. So all this previously held interest, so if you have got if you have got some shares 5 years before, 10 years before, or 50 years before, the original cost of investment is not relevant at the day of acquisition because you may have acquired this 33% many years before, right? Or even 1 year or 6 months. Anyway, it is not relevant now. So that's why the accounting standard requires that this originally acquired previously held interest should be valued at fair value at the day of acquisition. So it should be valued at fair value at the day of acquisition. That means if you have got some previously held equity interest, any shareholdings that you have to remeasure it at fair value at the day of acquisition. You have to revalue it at fair value at the day of acquisition. Not only any resulting gain or loss have to be recognized in profit and loss. It should go to P&L, profit or loss. One more requirement, the accounting standards require that. So under the Hong Kong Financial Reporting Number 3, business combination, we are required that if the acquirer has previously recognized any gain in the equity for financial asset, carried at fair value through other comprehensive income. So in the parent's own book, they may carry the financial asset as a fair value through other comprehensive income. So if they carry it as a fair value through other comprehensive income, then now they may have a fair value reserve in relation to this financial asset. If this is the case, that fair value reserve should be reclassified to equity, should be written off to equity, as if the previously held equity interest was sold. Okay? Certainly we cannot understand, right? So that's why we need an example, right? So we need an example. In this example, Apple, the parent, has acquired 5% of the shares. So 5% is the original situation, 5%. So how much we pay? We pay 100,000. So we pay 100,000 to acquire 5%. So in the parent's own book, in the separate financial statements, it has been measured at fair value for other comprehensive income. When you study I1, you know that we may carry it at fair value for profit and loss. Usually it is fair value for profit and loss as a financial asset, but you can designate it at fair value for other comprehensive income. So here we designate that it should be carried at fair value for other comprehensive income. The carrying amount is 230,000. Carrying amount 230,000. What does that mean? That means the fair value has increased to 230. So basically, because this is a fair value for other comprehensive income, the parent in its own book must have debited the investment and credited other comprehensive income, and therefore fair value reserve 130,000. You understand that other comprehensive income is the current year other comprehensive income. At each year end, other comprehensive income will be closer to fair value reserve, just like the profit and loss will be closer to retained earning, right? So we should have a fair value reserve, 130,000, as at 31st December 2008. And then suddenly something happened on 1st of June. On 1st of June, we acquired another 65%. So the status changed. It changed from a 5% subsidiary, 5% simple investment, to a 70% subsidiary. So it changed from a 5% simple investment to a 70% subsidiary. Why? Here. So because now it becomes a 70% subsidiary, so on 1st of June, that means the day of acquisition, we need to calculate goodwill. Therefore, we calculate goodwill. So we should be able to calculate the goodwill. Goodwill is calculated as the aggregate of the three items, and these three items will be compared to the fair value of the net asset. So the three items are, first, the consideration. This is the considerations that we pay to acquire the 65%. So we pay 3.9 million. We pay 3.9 million to acquire the 65%. So the first item is the 3.9 million, which is for the 65%. Okay? But this is only 65%. We still have 35% to go. Because this is a 70% subsidiary, there must be a 30% non-controlling interest. 30% non-controlling interest. So non-controlling interest will be 30%. So we search the question. We try to find out if we have got any fair value of non-controlling interest. Can you find it? No, right? We cannot find the fair value of non-controlling interest. That means no choice. We have to use the partial GUIL method, right? So therefore, we use the partial GUIL method here. Partial GUIL method means we will measure the non-controlling interest as a proportionate share of the fair value of the identifiable net asset. The question says that the fair value of the net asset is 4 million. Right? Fair value of net asset is 4 million. Proportionate share of the fair value of the net assets, this means 30% of the 4 million. So this is the proportionate share of the fair value of the identifiable net assets. So that's why NCI is measured as 1.2 million. Okay, so we are using partial GUIL method. Good. Partial GUIL method. And finally is the previously held interest for the original 5%. For the original 5%, it must be carried at fair value at the day of acquisition. The question says that on the day of acquisition, that means 1st of June, the fair value of this 5% is now 250. So it must be 250 so that we can do the consolidation. So it must be 250. Okay? So the fair value of this 5% is 250. But in your own book, in the parent's own book, it was only 230. It was only 230. Consolidation means we will consolidate everything of the parent and everything of the subsidiary. Right? When we do the consolidation entry, we must credit away the investment in subsidiary, 250, not 230. Right? So that's why it must be 250. So therefore, before we can do the consolidation, we have to remeasure it to 250. So if the book shows 230, we debit investment 20 to bring it from 230 to 250. So that's why we debit investments 250. This is basically a consolidation adjustment. You cannot force the parent to do so, right? Right? The parent, of course, the parent, because they do it at fair value for other comprehensive income, they can remeasure it to 250. If the parent has done so, we don't need to do, right? But if the parent did not do so, we cannot force the parent to do. So as a consolidation accountant, I will do so, right? So I will debit investments 20 to bring it from 230 to 250. Accounting standards say that any resulting gain or loss should be recognized in P&L, should be recognized in profit and loss. Therefore, here we credit P&L. We credit gain on deemed disposal. The name is not very important. Sometimes we may call it gain on step acquisition, or we may call it gain on business combinations achieved in stages. We understand that this is a step acquisition. We understand that this is a business combination achieved in stages. So it must be a P&L, profit, gain. I call it a gain on deemed disposal because basically the accounting treatment is just like we dispose the 5%, and then we purchase 70% at the day of acquisition. This is the accounting treatment. This is what we are doing here. So basically, the accounting treatment is just like we dispose the 5%, and therefore this 5% should be measured at fair value at the day of disposal, and then all this 70% should be measured at fair value at the day of acquisition as well. Right? It seems that we are disposing the 5%, and then we purchase 70% altogether at the day of acquisition. This is what we are doing. So that's why I call it a deemed disposal. So in the annual report, some company call it a gain on deemed disposal. Some company call it a gain on step acquisition or gain on business combination achieved in stages. We understand that this is a result of the financial reporting number 3, business combination. Okay? So after this journal entry, you really have 250 in your investment in subsidiary, and therefore the cost of the business combinations, 100% will be 5.35 million. Right? We just aggregate the three items together. This is 100% of the business combinations cost. And we'll compare this 5.35 million with the fair value of the net asset. The question says that the fair value of the net asset is 4 million. So what we pay minus what we get is goodwill. So goodwill is calculated at the day of acquisition. Okay? So now we may start to prepare our consolidation journal entry, our very familiar consolidation journal entry. So we credit away the investment in subsidiary. This is the investment in subsidiary for that 70%. Right? As we have said before, for this 70%, the investment, it is 4.15 million. Why is it 4.15? Because 3.9 million plus 250 is 4.15 million. This represents the 70% cost of investment, 4.15 million. And then we credit NCI, 1.2 million. This is what we have calculated. So basically, these two together is the amount that we pay, right? 100% what we pay. What we get is the net assets of the subsidiary, fair value adjustments, and goodwill. We don't have the details of the net assets. We don't have the figures for the assets and liability, but we do know that it must be the same as the equity. So we also do not have any detail of the equity. So that's why we simply debit share capital, retained earnings, etc. Anyway, we did need to debit all this equity at the day of acquisition. Right? It must be 4 million because the net asset is 4 million. So that's why the equity figure must be 4 million. Equity means net assets, right, in terms of the figures. We don't have any information on fair value adjustments. So the journal entry cannot balance. So the balancing figure is goodwill. So we debit goodwill, the same as what we expect. Okay, so this is the consolidation journal entry at the day of acquisition. And thereafter, you simply consolidate it as a simple, normal 70% subsidiary.